Hello students, myself Dr. Narendra Rally, Assistant Professor, Department of Management Studies, VSM College, Ramchandраpuram. I'm here to explain you the concepts of investment management for final year BBA students. Investment management unit 1. In the earlier classes, you have learned about the basics of investment, attributes of investment. In this video, let us learn about features of good investment, investment and speculation, also investment process. Features of good investment. What an investment is said to be a good investment if at all, if it is having the following features: returns, risk, safety, liquidity, marketability, capital, capital growth, stability of income, tax, shelter. What comprising all these elements in an investment, or comprising all these elements in an investment will tell us features of good investment. What is a return? When a person invests some amount, that some amount will be he will be able to he is able to expect something after his investment, that expecting something is what we call it as a return. Returns. These returns could be like two types. One second. The first one is capital gain, and the second one is like regular income. When we are able to continue investing in a particular product, we get continue income. When we thought of selling it, we will get capital gain or capital loss. First one is return. So the return refers to expected rate of return from an investment. It is an important characteristic of an investment and is the major factor which influences the pattern of investment that is made by the investor. Investor always prefers high rate of return for his investment. The returns could be in the form of dividend, interest, capital gain, etc. Here, I say the returns could be like dividend, capital gain, dividends, capital gain, interest. Yeah, returns are in these forms: dividend, capital gain, interest. Dividend in the sense, when we invest in shares, when we invest in equity shares, we get dividend. When we invest in debentures or bonds, we get interest. So therefore, apart from dividend interest, you have also one thing, that is capital gain. What is this capital gain? Okay, say for example, you just purchased an investment today, and you have been holding it from since the past 5 years. At the end of 5 year, at the end of fifth year, sell you just want to sell or you just want to sell or redeem the investment. While you just want to redeem the investment, uh, you will get you will get to know two options. If it is gain, we call it as capital gain or loss. Capital gain or capital loss. Okay, then what is the risk? It is one of the major characteristics of investment. Risk refers to the loss of principal amount. Here the second one is risk. Risk means loss of amount. Am I right? If you think risk means loss of amount, I say no. Risk is not the loss of amount. Risk is fear that we may lose the money. Risk means fear that we may lose money. That is, uh, if you put some amount of capital, that will either return or not. So that is why risk means the fear we may lose money. Fear of loss is a fear of loss. We call it as risk. Possible that is I can say, um, it refers to possibility of it refers to possibility of incurring losses. It refers to possibility of incurring losses. Losses in where? Losses in losses in financial transactions. Losses in financial transactions. And the next one, risk is inherent to any investment. So risk is uh, shares. There is a risk. Debentures. There is a risk. Derivatives. There is a risk. In each and every kind of equity, financial security, there is risk is inherent. The risk and return of an investment are related to each other. Here you have, in the earlier you have learned risk, and now you have learned what is, in the earlier you have learned return, and now you have learned what is risk. Investment analysis, the risk and return are always related to the risk and return, or the risk and return are related to each other in investments. The risks and related are related to each other in investments. Okay, they are related. Okay, how are they related? How are they related? I can say the higher is the risk, the higher is the risk, the higher is the return. If the amount of risk is high, the amount of return is also high, and vice versa. That is, if it is low, it is also low. Okay, risks may be Okay, this what are the risks? Okay, you have learned that risk is fear of loss. You have also learned that uh, you have also risk means fear of loss. What types of risks are there in this? And what are such fears? In what ways? I mean, you can say in what ways risk can appear. In what ways risk can appear? Risk can appear in the form of loss of loss of capital, or the second, it can be in the form of delay in delay in repayment, or in the form of non-payment of non-payment of interest, or in the form of variation in variation in returns, or in the form of variations in returns. These risks may be like, loss of capital, delay in repayment, non-payment of interest, and variability in returns. So all these are the types of, chances where the risk may happen. Why the risk is like that? Okay, in order to answer that, the risk of an investment depends on various factors. The risk of an investment depends on various, that is, the risk of an investment the risk of an investment is dependent upon various factors. The risk of an investment is dependent upon various factors. So what are they? What are those various factors in this? Maturity period greater than higher maturity period. That is, the risk may be why that is because of higher higher maturity period. 2, lower credit worthiness. Also, it depends upon nature of nature of investment. Okay, all these are all the risk is dependent upon this. For example, in order to understand this, for example, risk of equity shares have highest risk compared to debt instrument. Debt instrument means debentures or bonds have less risk. So this is all about risk. And the next one is safety. Yeah, what do you mean by safety? What do you mean by safety? Safety is another feature which an investor desires for investments. Safety. Safety is another feature which an investor desires for his investments. Safety implies return, certainty of return of capital without loss of money. In the earlier we have learned that the earlier we have learned about risk. That is fear of loss. In the earlier we have learned that risk means fear of loss. Here the safety indicates here the safety indicates return of capital without loss, return of capital without loss, also without without delay in time. So this makes return of capital without loss and also without delay in time. This indicates the safety. So every investor expects to get back his capital on maturity without loss or any without delay. Safety refers to protection of investors' principal amount and expected rate of return. Here the safety indicates protection of safety indicates protection of principal, and along with protecting the capital, expected rate of return is also protected. That is expected rate of return. So protection of principal and expected rate of return, both these things come under safety. If an investor prefers less risky securities, chooses government bonds. In case investor prefers high rate of return, will choose private security, that is equity shares and all. So and the next one is liquidity. What do you mean by liquidity? What do you mean by liquidity? Liquidity is an investment is easily saleable. So when an investment is easily saleable, we call that particular investment is liquid. That particular investment is liquid. Here, what I mean to say is it is easily saleable, it is easily saleable in the market without loss of without loss of money, or you know it, right? Money or time. This is known as liquidity. When liquidity is high, the return may be low. You have to you have know this point that if we want highly liquid investments, if the liquidity is high, the returns will be low. Why? Because the principal is being protected. The principal is being protected. That means you will be given an offer to protect your principal so that your principal is not getting affected. Therefore, when such principal is not getting affected and isn't invested in anywhere, so the returns from that one such particular principal is always low. This is liquidity. And the next one is marketability. What is this marketability? Marketability means buying and selling of securities in the market. Buying plus selling of securities in buying and selling of securities in market. So here market or other ways, transferability or saleability of an asset. Saleability of an asset, that is, you can say it as buying and selling of securities in a market, or in the other sense you can say transferability or transferability or saleability. Securities listed in stock market which are more easily marketable than which are not listed. Public limited company shares are more easily transferable than those of private limited companies. So easily market the shares, that securities that we have been investing must be like easily marketable, that is easy to buy and sell. And the next one is capital growth. And the next one is capital growth. What is this capital growth? Capital growth has become an important characteristic of investment. The growth of investment depends on the growth of industry. Capital growth refers to appreciation of appreciation of investment. Capital growth refers to appreciation of investment. That means I said already, if we say for example, if you invest 1 lakh rupees at the end of in this month, and you have been keeping that 1 lakh investment till 10 year or till say 5 years, at the end of fifth year this 1 lakh must be identified for a growth, say 1 lakh 50,000, 1 lakh 50,000. This extra 50,000 is like growth of the capital. So and the next one is income. What is the stability of income? In the earlier video, you have capital growth. That means capital growth means doubling the capital. But here stability of income. I said returns are of two types: income and capital gain. You comes under the point of capital growth, the income. Here, that income that we have been investing, so that must be stable. That is, it should be consistent and constant. Another major characteristic feature of the investment is stability of income. Stability of income looks for different paths just as security of the principal. Every investor considers stability of monetary income. It refers to constant return, stable return, constant return, continuous return. And the next last one is tax shelter. What is this tax shelter? Some investment invest to to benefit from income tax, or to benefit from the taxation. So we do some investment we do some investments to reduce the tax on us. So that is tax shelter. Tax benefits are of mainly three kinds. Tax benefits: initial tax benefit, initial tax benefit, continuing tax benefit and the terminal tax benefit. Initial tax benefit is the tax relief. So, initial tax benefit, it is the tax relief. Initial tax benefit is the tax relief enjoyed by the investor at the time of tax relief of making making investment. Okay, then what is continuing tax? Continuing tax benefit. What is continuing tax benefit? The continuing tax benefit refers to tax shield associated with periodic returns. That is tax tax shields. You have minimum exemption limit ఉంది కదా, minimum minimum exemption ఇలాంటివన్నీ కూడా tax shields. Okay, what is this terminal tax benefit? Terminal tax. What is this terminal tax benefit? Terminal tax benefit is the relief from taxation when an investment is realized or liquidated. When an investment is realized or liquidated. Terminal in the sense exit. Terminal in the sense the word terminal refers to maximum exit. So that is exiting from the investment when we have tax benefit. That is terminal tax benefits. So uh, returns, risk, safety, marketability, capital, stability, income, tax shelter. So all these are futures of good investment. Thank you.